So we're going to start off with Don. He sent a question via email. And Don wanted to know, for a given equity, for example, AT&T, how does your software program identify optimal call options to sell for various time periods? And he goes on to say, in that regard, would you discuss how to manage the short call that goes in the money, especially if I want to keep the stock? Very good, Don. We're going to use PowerOptions for both of those. Let me go ahead and pause the screen. Find my proper button there. And we're going to navigate back over to PowerOptions. And fantastic. There we go. Okay, so if you're looking for a specific type of search, Don, meaning, let's say I want to do dividend-paying stocks. I want to do covered calls, Don, excuse me, on dividend-paying stocks with a certain range that have a lower volatility and a relatively, high 2 to 3% dividend, similar to AT&T, maybe Verizon, Comcast, Kraft, things of that nature. You're looking to be more safe on the side of covered calls with less volatility using the dividend-paying stocks. So it's not that the tool is showing you the optimal covered call trade. When you're in the search for covered calls, it's showing you the results of what matched your criteria. Whether you want to be in the money, you want to be out of the money, you want to be right at the money to maximize return. In this case, Don, what I'm assuming is you're looking at a dividend-paying stock you want to hold long-term. As you mentioned, what to do with a short call as it goes in the money if you want to hold the stock. So what I may do is just create a basic search. We're going to go ahead and go out to January, even if it's only 16 days. And I'm going to tell the system, I want at least a 1% downside protection, at least a 1% return if assigned. Now, I'm going to put this at 0.7 because we're looking at dividend-paying stocks for 16 days. And I want to be just slightly out of the money, maybe 1% to 3% out of the money, hoping the stock stays below it. I'm trying to collect a dividend-like income on a weekly, bi-weekly, or month-by-month basis. Not going to worry about the option bid price, probability, or anything like that. I'm taking care of that with the out-of-the-money range and the hope for protection. We are going to look for minimal volume and some basic open interest. Now, I'm not going to put in any fundamentals to look for a bullish stock or bearish stock. Some of those dividend stocks might be up or down. What I am going to do is tell the system to only show me stocks that have a mid to large cap, larger cap stocks. We're going to go into the middle range here, mid to large. I'm going to put in a screen of at least 2,500. This particular field is measured in millions, so I want the market cap to be above 2,500. And let's put the dividend yield at 2.5. I don't know if AT&T is right in that wheelhouse. We're going to look at your AT&T example in just a moment. But I'm also going to avoid earnings between now and expiration. Okay, so a few basic things. What I want to target for my downside protection and return for the covered call. I want to be out of the money. Hopefully it expires worthless to continue to collect a dividend-like income against my already dividend-paying stock. Some basic volume and open interest. We're going to avoid earnings, and we're just going to look for mid to large cap stocks with a 2.5% yield. I'm not worried right now in the technicals that the stock is trading in an uptrend, which I'd normally look for. If it has a positive MACD, average stock volume might be a good one. Let's put in 750,000. All right, well, let's see what we've got here. Hopefully we see some common names. Nordstrom, Diamondback, Kohl's, Royal Caribbean, Devon Energy. Are these the optimal covered calls for each of these potential stocks? Well, Royal Caribbean comes up a couple times. It's the 73.75 strike. We see the January 74.5, January 75, a little bit further out of the money, and the January 75.50. So there's 3 different covered calls here, Don. Which one's the optimal? Well, that's where it comes down to you. We don't make direct recommendations or suggestions on which covered call you should trade. We're showing you the potentials that match the criteria that you wanted: a minimal downside protection, reasonable percent if assigned, and certain range out of money. I should have put percent if unchanged. My apologies. Let's put 0.7% if unchanged in addition to the percent if assigned. That kept us about the same range. Let's see if T came up, just out of curiosity. Okay. Nope. T is not in there, which tells us what? it most likely doesn't offer a 1% downside protection with the out-of-the-money range for this expiration cycle. We may have to go out further to February to see if T comes up. Nope, no premium there, or they have earnings coming up, but it would have removed from February if they had earnings coming up. Maybe it's not the cap that I want. Oh, the dividend. Thank you there. Let's just put 1.5. Not sure what T's dividend is off the top of my head. Okay. In any case, but that's what the tool does. Okay, we'll talk about T just a little bit more in a second. So how I set up the tool, of course, Don, is going to be dependent on what I want to see in my criteria, what I want to see for this strategy. And then you'll be able to see which ones, narrow it down further. I can increase my downside protection requirement to filter some of these out. Yeah, if I just look for greater than 3.5%, we'd probably only have 100 or 50 different results here. I'm sorry, 50 different results here from our 265 based on the criteria that we're using. Now, as you know, there is something else. In the morning, you receive an email. You might receive an email called the Price Watch Alerts and Morning Updates. Why am I bringing this up? Well, it's because Don used the term optimal in his email. And each one of these selections that comes up, today's optimal covered call, this might be what he's referring to. And that's good too. I wanted to show the search first that you can customize it any way you want to match your needs or use our defaults, such as the covered call monthly picks of the day or weekly picks of the day that Ernie tested. This email is designed by a third party, Don. They use our patented search tools to identify positions that match their criteria for covered call positions. They send this email out to their subscribers and send it out to our members as well as a perk for being able to use the search tool. Ernie and I and the staff members here, we do not track these positions. We don't know what this risk assessment is. We've asked them several times. They've never given us insight into what's used for that risk assessment. It's our hope that when investors see these potential covered call ideas, let's take BURL, for example, came up today, buy 100 shares at $259. That's out of my price range, but that's okay. And sell one contract of the January 8th weekly call, $257.5, slightly in the money for $645. Okay. Now, if I'm a Power Options user and I see this, and this is within my price range, and I say this might look like an interesting trade, but what else is there? Don't want to trade off of this. What I'm going to do is go back to Power Options. Oh, sorry, folks. And I'll look up BURL, for example, and I'll go to the option chain. And let's just look at the call chain and go to January 8th. Why am I doing this? On our call chain, we show you the returns that are important to a covered call trader. The downside protection if entered as a covered call, that percent return if unchanged, and percent if assigned. We're looking at the 257.50 that they selected, not us, which offers a good 3% downside protection, has a 2.1% return for 9 days trade. Well, if I want a little bit more downside protection, and I'm comfortable with a little bit less of a return, so it looks like a wide bid-ask spread, so I might not be able to get that one. But I could go down to the 250 strike. It still offers me a 1.1% return if assigned for 9 days. That's great, but with a 5%, almost 5% downside protection. Stock can fall a little bit further, but if it stays up above 250 in the next 9 days, we make 1.1%. Did we take off half the return? Yes, to get more downside protection if our concern is the market. If we're concerned of a market pullback or market weakness going into the next week or so. Then, of course, what I would do is further research the stock as we normally would. I would take a look at the stock chart, company information, news profile to make sure this is a position that matches my goals, matches my tolerance, matches the criteria I would want for a covered call position. We do not compile the price watch alerts and morning updates. We don't have the direct criteria that they use. Further insight on that, I'll get to that in a moment. But when you create your own search, or you use our defaults as a stepping stone, Don, to create your own search, you can then click Get Results by Email, and you can pick which covered call results you want emailed to you at any time during the trading day, or naked puts, credit spreads, debit spreads. So aside from the covered call and the price watch alerts, you can tell the system what search results you'd want to have emailed to you at a given time during the day. There is a video I'll email you later on. It's an older video, and it talks about how to use the price watch alerts, how to set up your own search, and have the results emailed to you instead of just using those particular price watch alerts and morning updates. Now, all that being said, if I do own a stock, AT&T, as I'm tracking even just the long stock position in the portfolio, here's my one long stock at AT&T, we bought it about $29 back on November 27th. It's down a little bit from our purchase price. But just like any other strategy, even if I'm just tracking a long stock, we can go to Position Actions and Position Analysis. This gives us just a basic breakdown of the position. But as I scroll further down, we see potential covered calls with the new downside protection based on my cost basis, not what the current market is offering, but from my cost basis of 29. If I sold, say, the 29th of January 29 call, I'd have a 1.7% downside protection and a 1.7% potential return if assigned on the position for about 30 days. Not too bad for a dividend-paying type stock, of course, in that case. But these are not direct recommendations or suggestions. It's giving you ideas. See, for my cost basis at $29, I'm not going to sell the January 28.50 call. My cost basis is $29. This only gives me 35 cents. So if the stock does go up above $28.50, I'm locking myself into a loss. Same with the 15th of January and the 22nd of January at this strike. But the 28.50, the at the money right now for T, does give me a 0.5% return if assigned and a 2.3% downside protection. That's better than potentially looking at a 1.8% loss today after 33 days. So this is not telling you which one's optimal. PowerOptions tools are showing you which ones are available, which ones might be a good structure that are offering at least a 1% downside protection, at least most cases, the percent if assigned as well, but with a reasonable premium. Direct unchanged yield or premium against the current stock price, at least 1%, as you can see. But you can see it's your decision now. These necessarily wouldn't meet your goals or your needs for the position, or you could look to the option chain to evaluate further. The last part of your question, what will you consider to do to manage a covered call that goes in the money? Well, you're likely going to roll it. We're going to use a simulated position that back in November, we bought AT&T at $27 per share. Around the same time, I sold the January 26 call for $1.75. Well, it's $1 below my price at a low strike, but it gives me 75 cents a time premium, so I'm still looking to make 2.9% on this position, on this covered call if assigned, the max return. Now the stock's run up to $28.50. We want to stay in the position. How do we do it? Well, we're going to have to look to buy to close this call and roll it up, and maybe roll it further out in time if you want to roll for a credit. But to keep it easier for you, we'll use the More Information button once again. Go to Position Actions and go to Position Analysis from the covered call I'm tracking in my portfolio. We get a breakdown of our current covered call position. My current return is 2.9%, and pretty much 97% of the 3% I expected to make, max return if I'm assigned on. And then down below, it's going to show us the rollout opportunities. What this is showing us, let me change that pen color there. Sorry, folks. Go light green today. So our current buyback cost is going to be around $2.51 with the stock trading at $24, basically right at intrinsic value. But we could roll out further from January 15th out to February, say to the 28th strike for the 5th or for the 19th, it looks like. So let's just say with the 19th, we could get another $1.13. Now the adjusted net credit stays positive. How is that positive if I'm buying it back for $2.51 and getting $1.13? I'm at a debit of $1.40, $1.38. Well, it's also including the $1.75 you initially took in and still collected. So here we have a potential for the next 51 days to increase our return from 3% to 5.1. But this is still in the money, isn't it? And that's what these shaded signs are telling us, that these are the in the money options for T right now. Oh, hold on, folks. All right, so if I wanted to go out of the money, I'm probably targeting a 29. But again, we're going to get a smaller premium because it's out of the money, and we have to go further out in time. Why are we not seeing the earlier February 29 strike or the 29.50? And it's likely because the premium is too low, so you're ending up with an adjusted net credit of a negative value or a debit. Might still increase your return, but you're going to cancel out your downside protection while rolling for a debit. You'll actually have a negative downside protection in that situation. So you'd want to consider, does the potential roll for the position, if I rolled out to February 19th, does this match my trading goals for the covered call strategy in my portfolio? Meaning that if my target on this particular stock is 1.5% every 20 to 30 days, does going out in 51 days and increasing my return from 3 that I have right now to 5.1% match my targeted goals? It doesn't, does it? It's just short of that. I'm only gaining 2.1%. I'd want to be gaining 3% by increasing it out 50 days in time, roughly, or 60 days, close to that. But if I want to stay in the position, you'll see the opportunities here to roll the position, Don, to be able to roll for a credit, although you may find yourself going extra amounts out in time. The key is, if you want to stay into a stock ahead of time, you want to look to roll the call up, roll the call out in time once it starts to go in the money. So I might have looked to roll this position when the stock started to move just above 26, had that pullback before it really spiked up in December, and then it pulled back from there. But right as it started to go above 26, I might have rolled up to the 27, then rolled up to the 28. I'd probably be at 29 right now with the stock trading at 28.50 if your goal is to hold on to the stock long term. But you'd want to use the portfolio tools here to evaluate which levels you'd want to go to if you wanted to potentially roll for a credit or a debit. Okay. All right, so that's going to cover our covered call topics. I said I would email you the video later. I'm just going to look for it right now very quickly. No, I'm sorry. Let me go back. My apologies, folks. Let's just go back here. There's a video again that describes the price watch alerts. Basically, what they are and how to set up your own search. Let's see here. So I'm in the webinars page. Here we go. Trade recommendations, or what are the price watch alerts from 3/26/2018, Don. That'll give you insight into what are the price watch alerts, how we know that they are compiled, what you should do with them as we already reviewed, and also how to get alternative trading ideas for covered calls using the PowerOptions tools and that get search results by email as well. Now, I'll put them all together, sorry. So, Lloyd, you've been patient, you've been waiting, so let me take yours right now. Which level of subscriber do I need in order to see subscriber access webinars? I clicked on what was taken to the subscription page. This is my webinar account, Lloyd. You're currently registered as a free trial member to PowerOptions right now with the special bonus that you took advantage of. You've got your 30 days free. You see here, even on mine, the most recent 5 or so videos in some of the sections, we only show, on the PowerOptions tools, you've access to everything. The option strategies, some of the more recent ones, they're only for subscribers. They're not open to trial members, only to subscribe. You've got 30 days free. Here's a little trick. Shh. Here's my title. It's now the right time to enter covered calls. Okay, I want to watch this video, but I can't. I'm not a subscriber. I'm a trial member, Lloyd, so I can't watch it. It'll take me to a subscription page. The real answer to your question is any subscription level, but you're still on your trial. But here's a trick. go to YouTube, go to PowerOptions, copy your title that you want to view, paste it. You can watch it right here on YouTube. Okay. I don't want to discuss, get into that too much. It's something that I'm going to be changing a lot of the webinar platform structure. It's going to be organized to strategy as well as concepts and more going into the new year. That subscriber access thing we did for a specific reason. Everything used to be open all the time, and what we were trying to do is encourage our free trial members on the 14-day free trial, Lloyd, to subscribe to see more of the information, the most recent information as well. But since I usually post everything on YouTube, next year going into 2021, we're going to have, of course, blueprint owner only webinars related to the married put concepts, probably at least one a month. We're going to have YouTube subscriber videos only for our community here at YouTube that are subscribed to the YouTube channel, which won't be seen on PowerOptions or on Radioactive Trading. And then, of course, we'll have PowerOptions members only webinars as well, and they're going to be in different places. Why are we making it so confusing? Well, it's because there's 3 different communities that we really address in these situations for our educational videos. So I want to make sure everyone's taken care of, especially the blueprint owners, especially the PowerOptions subscribers. And every now and then we'll throw out just a special to YouTube for YouTube channel subscribers as well. But you're going to see some changes into the format and organization of the webinars once I say that, and I have a plan, and it's written out, and it's diagrammed for the programmers right here in front of me, as a matter of fact. But the thing is, Lloyd, is that if something changes in the market, or the market does start to turn in the first 2 weeks of January, we're going to be very busy doing discussions on hedge management, hedging portfolios. We're going to have that bull put credit spread product coming out in January as well, real soon. So there's going to be a lot of stuff going on. But yes, I'm definitely going to take care of this and organize this in a much better fashion. And we're going to remove some of the older videos. Some of them have already been replaced, but we're going to remove some of those older videos so everything's just more recent. And 186 videos in 2020 alone, so there's plenty of content to choose from on all the strategies, 90% of the strategies, and the context as well.